Hey Jamie, how are you?
Good, thanks. How are you?
All right. So instead of me leading the first question, what is on your mind, uh, biggest issue that you see out there? Maybe your reaction to Powell pushing back on a good CPI number last week.
Well, it was interesting, wasn't it? He was asked at the press conference if the CPI data had, changed any of their minds because they saw that. If I'm right in saying they saw the numbers that morning, is that right? But they
Yeah.
didn't. But I don't think any of them officially changed their dot plots. Um, However, I think it's quite clear that if we continue to get numbers like that, softish data, disinflation gathering steam, then those dot plots will change, and that will kind of render the revision upwards that we saw last week kind of redundant.
Yeah.
It's a kind of a whipsaw move in thinking, mentality, and probably market pricing. But I mean, here we are. Every time I'm on, we always talk about the market fighting the Fed. It's been a losing sort of fight over the last couple of years, but they continue to fight the Fed in a way because of what I'm seeing now is two cuts priced in for the year, and the dot plots are only suggesting one. However, as we just sort of just said there, perhaps those dot plots will have to be revised back down again in 3 months.
Yeah. So that begs a question, Jamie, because even after the Fed pushed back, yields dropped to a new low. And it's a possibility if rates keep coming down, and I still think that rates are coming down. We keep getting lower highs in yields here,
Mm-hmm.
like you know, the last peak
Where are
that
we now? We're at
was
420
here.
on the 10 year. I mean, that's
Yeah,
what,
we're at 426 right here.
426, right?
Okay, so we had this failure from 460. This is when
Mm-hmm.
people are saying the Fed might even consider a hike, and then they said no hike.
Yeah.
Does the Fed lead the market or follow it?
Well, I think the story of the last. Well, when did the Fed last raise rates? It was July last year, wasn't it? So it's almost a year since the
Right.
Fed raised rates, and that's when it kind of stopped. So we're almost a year into that, and where have we gone in market pricing since then? I mean, I seem to recall at the start of the year, January 1st this year, the market was pricing in what, six cuts?
Yeah, it was crazy. Yeah.
Six cuts. And now we're down to, well, two, and the Fed is indicating one. And as you just said, only a few weeks ago, we're talking about none, possibly a rate hike. So I think the Fed is leading the market. I think that's fairly clear.
Okay.
Um, and but the interesting thing for me is
But
that the
they
market.
led didn't but didn't they lead the market to go ahead and look for six cuts?
Well, maybe not six, but you're right. They did have that
So
dovish pivot, didn't they? And
yeah,
that seemed to
yeah.
be
So
short-lived.
that they misled the market. They didn't lead the market.
Misleading, yeah, perhaps.
Okay.
Perhaps that's more accurate. I mean, but when was that? That was in the early part of the year. Maybe they were too gung ho, a bit too hasty to put too much faith in one or two inflation prints. They turned out to be not quite an accurate read. It's all
Okay.
ifs and buts, and the proof of the pudding is always and only in the eating. And we will see if we do get more of these soft inflation prints. The PPI number last week was also quite soft. So if the pipeline pressures for prices is toward continued disinflation, then I
Okay.
suppose it's fair to say that the Fed might have to sort of backtrack again and go for the two cuts. However, we had the Minneapolis Fed President Neil Kashkari just on the wires. He was on TV yesterday saying that one cut
One.
towards the end of the year seems realistic. Does he speak for the majority? The median would suggest he probably does. However, Powell, as we know, is he's more dovish and he probably carries sway, but he's not really speaking for the median right now, probably.
Is he a
It's up in the
voting
air.
member, Jamie? Is
Kashkari? Oh, that's a good
yes.
question. I don't know, to be honest. He may
Yeah, I
not
don't
be,
think
but
he is.
right, okay,
Okay,
okay.
I
So
think
he's
he's
got
a
maybe more. He can speak
he,
more freely, perhaps.
yeah, he's a mouthpiece. It's
It's
probably
quite a
sent
vocal
out
one.
there. Huh? Have you ever been, I'm
Yeah, yeah.
I'm Face's mouthpiece. It's not a bad thing to be. You're a Reuters mouthpiece.
No,
Anyway,
no,
so
no, I would never claim that. But well, listen,
all right,
but
Jamie.
one cut. I mean, but to be fair to him, one cut this year is now the median projection. So
Yeah.
he is kind of in a way speaking for the majority. But I mean, at the end of the day, does one cut this year or two cuts when they come? Is that really? I mean, is it? I know we talk
Meaningful?
about this. Yeah,
Yeah. You got
I
me.
suppose. I suppose it's to me. It's whether it signals the start of a cycle, and how long is that cycle going to be? How deep is the cycle, the easing cycle, going to be? I think that's much more important for markets, rather than if it's when does the first cut come?
Well, as a technician and, just looking at the move we had from 5 to 380 here, if we have the same type of thing from here, it gives you
Yeah,
350, takes out these lows. So,
well,
uh,
that's quite a long way down, and that looks quite a long way down.
could Europe be the problem that sends rates down? Are you paying attention to what happened in Europe and some political instability and
Absolutely, yeah.
okay, is that the big story going forward the rest of the summer until the U.S. elections? Whether the snap elections in France and that if there's still demand for bonds, French bonds, which unlike us, they don't have a bank to come in and buy them and support them.
Well, they do, don't they? They have the ECB.
Okay, they have but
Ultimately,
they don't have a plan, do they? They don't have a plan in to go ahead and do it. Was the
no,
ECB
but yeah.
buying the gilts when the gilts
No,
had a
no, no,
crisis, or
not
that was a
gilts.
BOE?
That would be the Bank of England, yeah. Obviously,
Okay,
the
so the
sterling,
ECB didn't help them out. So why is the ECB going to help France out if they have trouble?
because France is not only in the eurozone, it's core Europe, well,
Yeah,
core euro.
yeah, true.
Obviously, we're kind of back in, or we could be back in 2012, 2010, 11, 12 territory. I think you mentioned earlier the spreads, French spreads with Germany are now up to 75, nearly 80 basis points. That's the highest since 2012, I think. And of course, it was in 2012, July the 26th, that year, that Mario Draghi came out and said
Yeah.
that the ECB would do whatever it takes. And I mean, you have to look at what's happened since, and to think that the ECB would. Well, when he said that, everything changed. I mean, it might be a bit cliched, it might be a bit simplistic, but everything changed when he basically said that the ECB would be the backstop for any eurozone
So they
country.
could do
And
that again.
absolutely, I'm not sure of the mechanics of it, what programs they would use, whether it would be existing programs, a combination of existing programs, whether they would have to tweak them or come up with new ones. But if the ECB was going to backstop the periphery, Spain, Italy, Portugal, Greece, etc., it will certainly have no hesitations in coming in to backstop France. Because if France goes, then the whole eurozone project goes, and I don't think that's in anyone's thinking in Frankfurt or any of the capitals of the eurozone. So it might take some sort of inventive financial engineering and again, whatever it takes, but they will backstop France. I've got no doubt about that. It could get messy in the interim, and we could see spreads blow out further. We've had the ratings agencies come out warning about downgrades that has spillover effects on the banking system, etc., and borrowing costs. But I don't think the ECB would stand by
Okay.
and let France go under. No.
So let's go into the banking system, Jamie. The statement from Jerome Powell is banks are strong. They've repaired their balance sheet. They're financially in a good position. They got rid of the emergency facility from SVB. And then, those are
Well, I think
words.
some banks are still taking up some of those. There was a couple of emergency lending facilities introduced in March last year, and I think there are a handful of banks that are still tapping that. If I'm not mistaken, but it's very small amounts, isn't it?
Okay.
And
I thought they ended it, and my question is, do banks really look strong? And even the money center banks, Jamie, with the huge moves that we've been having in equities in general, not in general, specifically narrow advance with tech leading, the banks aren't making new highs here. And that's even this negative price action so far. I'd love to see one more high, but especially in KRE, this negative action has happened with yields falling.
is that the banking index
Which
there that you're showing me? Yeah, the KRE.
this one?
Yeah, the banking. Yeah,
Yeah, this is
the
regionals, and
regional banks, of course. Yeah,
yeah, yeah, and this is why the Russell can't get off the ground. So the charts are saying the regionals aren't out of the woods.
Look at that. I think there's a. I'm no technician or chartist, but it looks like we're coming up to support there.
Very important
Around.
support.
Yeah, looks like quite big. Going back
But
to.
when you look at it through a telescope here, Jamie, and you could use this on Reuters, it's fine with me. But this was the crisis, right? And this has been the recovery since the crisis in March of
Right, so it's not been.
23. Okay.
So we have recovered, but by no means we haven't.
Yeah,
Probably
like
half of the
not even just got back to where it broke down from and starting to roll over again. I still think there's going to be some headlines about banks coming up, especially later in the year.
If you're right, and you may well be right. If there are more problems with the regional banks, I think the Fed was pretty quick to act in March last year.
Yeah, they were.
It was very quick to act. If I recall, it was March 16, 17 over a weekend. Boom, they came in with programs and facilities, and I think they would, we're talking about ECB backstopping France. I think the Fed would come in very quickly and offer whatever kind of lending facilities, discount windows, or special rates, whatever it takes to backstop the banking system.
Okay.
We may get interim, we may get more weakness, but I suppose it's like anything, until it becomes a problem. And you said Powell himself doesn't see any problems. The Fed doesn't see any major cracks appearing. That's not to say they won't, but right now, in the here and now, on June the 17th, they don't see anything cracking right now.
Well,
but if they did,
Bernanke said things were contained too, right?
But he was saying, was he not saying that after things had started to crack? Time.
So in your mind, things haven't started to crack.
Well, I don't see it just yet. I mean, maybe if as you say, those support lines break and shares really start to take a bath, then I think that would get everyone's shackles up.
Okay, and your view on the upcoming elections in the U.S., does it matter in financial markets or tax policy which one is elected if they could pull off an election?
I think I don't think we're seeing any election pricing play into financial markets now. As I say, June, we're 5 months away, just under 5 months away. I don't see any election pricing. You've mentioned stocks are at all-time highs.
You're right.
Yields are coming down. Volatility is at historic lows. Credit spreads, high yield spreads are super tight still. Now, you can argue whether that's right or wrong, but right now, I just don't see any election risk or pricing being put into those prices just yet. I think that will change. Obviously, the closer we get to it, I think that may change. But right now, I don't see any election risk. Do you?
Well, the market's with the VIX, like you mentioned, where it's at, there's no risk. It's complete complacency, and that's what makes me nervous.
Well, maybe the VIX is not the best indicator because it's a 30-day.
All right, credit spreads.
Credit spreads, yeah. High yield spreads are super tight.
Yeah, so there's a lot of complacency. Everyone thinks it's going to be all right. Even you, which I give you a lot of credibility, Jamie. Every problem I bring up, the Fed could fix. So why worry? Be happy.
has the well since I mean since 2008 and since COVID, has there been a problem that the Fed hasn't fixed, at least on the
No,
face of it or temporarily?
no. So recency bias backs it up that the Fed is there as a backstop. So there is a Fed put. For a while, people were saying
I
there
think so.
was
Yeah,
no
yeah.
Fed put.
No,
Okay.
I think there is. If we talk about the Fed put in those terms, in the broadest terms, but of course that's part of the Fed's mandate. It has to ensure financial stability, the stability of the financial system, and it's not going to let the regional banking system collapse, or it's not going to let the treasury market collapse. It's not going to let it's not in the business of setting asset prices or values, but it's certainly in the business of making sure the whole system doesn't go under. So yeah,
Okay. Is all
I
right.
think the Fed put is there, and in terms of the Fed balance sheet, it was interesting. I was at the iConnections conference in Miami in January, the big sort of hedge fund and alts investment conference in January, and there was a panel. I can't remember who was. I think it was Zervos and Mike Wilson at Morgan Stanley. They were on a panel, and they basically agreed, and I tend to agree with them, that the Fed will maintain a super huge, super large balance sheet as far as the eye can see. We're talking like 5, 6, 7 trillion balance sheet. So the Fed will do QT and it will reduce the balance sheet, but it's not going to get it back down to anything like what it was pre 2008.
Okay, and they did reduce QT on treasuries, but not on mortgage-backed securities. Why? Are they worried about what the paper is backed by on the mortgage-backed security side,
Well,
or just
possibly,
trying to
and I think
support the bond market?
well, I think where are we on 30-year mortgages? I haven't looked for a while, but we are what 6 or 7%.
Yeah.
That's pretty high, especially if you're coming off. If you locked in down at 2 or 3%, and that's rolling off, and you're going up to 7%.
Yeah.
So maybe that was part of the thinking.
Okay.
Uh,
All
so
right.
yeah,
So,
but just to, as always, there's always another hand. While the Fed might maintain a huge balance sheet, and I think it will, of 6, 7 trillion dollars as a percentage of GDP and as a share of the market, that's actually going down.
okay. So I'm showing Jamie's feed. You have to follow Jamie at Reuters, Jamie, so you could keep in touch with what he's seen in the market. Do you think that the move to the right in Europe is mainly driven by migration issues and border issues? Do you think that's a foreshadowing of what's going on in the U.S. and all over the world, that we're moving, the pendulum has swung from left to right in a pretty serious way?
Oh, you can. I mean, there's a thousand arguments for why the right there has been or there is a rise of the right of the far right in Europe or in the States. Probably don't have time to get into it all here, but I think it's undeniable that it is real and it's happening, and we'll see in France whether that goes further and Le Pen actually gets in, and the Front National or the far right gets in France. Um, I suppose what we here to talk about is, does that have any impact on market pricing? And I think, as I said earlier, the credit ratings agencies are warning of the rise of the right in Europe and some of the policies that may have economic policies, whether it forces France towards the Eurozone exit or puts pressure there. Here in the US, it's obviously we don't have the Eurozone, but I think Trump has. I think there are some concerns about maybe the independence of the Fed. There's obviously tariff policies and trade wars. So these do have real consequences. And as you said earlier, maybe markets are slightly complacent right now, but there will come a time soon enough perhaps
I,
when they can't be complacent and they will have to react accordingly.
well, here's John. My sister is John Q. Public for me, and I brought this up to other guys. And she said, Dale, I'm going to get out of the market in October and get back in after the election. So a lot of people are thinking everything's okay until the fall. So
That would
wouldn't
seem
the
fair enough.
surprise, wouldn't that be a surprise that it really shouldn't be that convenient that someone who's not an expert is going to have a perfect timing strategy for when to leave the market to avoid the downside and re-enter at after the downside has completed. I give that a 1 in a million shot. How about you?
If it was so simplistic,
Yeah,
everyone would be doing it, and we'd all be sitting on some,
well, I think a lot. Is there anything that could
island.
throw? What would be the one thing of everything that you watch that could throw a monkey wrench into everything being okay until the U.S. elections?
Oh, good question. Obviously, we've got the French elections.
Right.
I think we can. I think we can maybe discount the UK election. I think that's basically a foregone conclusion. And to be honest, there's not much of a difference in terms of, certainly economic policy, even tax policy. There's not much of a difference between the two main parties there. So we can kind of maybe park that to one side. In terms of global impact, the French election could be significant, most certainly, and we could get a lot of volatility. And that would spill over, obviously, into Eurozone assets, and it would certainly push down or push up spreads in Europe, force maybe money into the dollar, into treasuries, even more money into the dollar and into treasuries, so you could get some outside market reaction there. What else?
What's a BOE going to do this week, Jamie?
Nothing.
Like usual. Right. All right.
So far,
all right. What's the BOJ going to do? Like
nothing.
They did last week. They did nothing. Do you think there's something could come out of the BOJ? Like
the Bank of Japan's an interesting. I think, but they're. I mean, I was kind of thinking, and I kind of wrote last week, or I kind of threw it out there. If the Bank of Japan wants to continue normalizing policy, if it wants to start tapering bond purchases, etc., raise rates even, raise rates again, what are the ideal set of global conditions that it would seek to do that in? You would have to think a fairly stable Fed, fairly steady, relaxed Fed, possibly tilting towards easing. Okay, the dollar's rising, but it's hardly going gangbusters. Volatility, as we just discussed, across the board, across assets, is ultra low. Macro volatility is low. Credit spreads are tight. Japanese stocks are doing well. Is that not the kind of conditions in which to start or to continue normalizing policy? You would think so. So if they've not done it now, it begs the question, what are they waiting for? And I'm not quite sure what the answer is there. Maybe domestic conditions, they're afraid of raising rates because of the impact on consumers. I get all that. But it's been well flagged enough, and as I say, the overall macro environment could not be more benign or conducive to continued or accelerated normalization. So I'm not quite sure what they're waiting for. We'll find out maybe next month. But by next month, France could be, all over the place, and we could get much more volatility. Could be much higher, general market volatility, and I don't think they'll be inclined to move in those kind of circumstances.
Well, I've heard from many guys that predict things that they felt that this next crisis, unlike 08, would begin in Europe, then spread to Asia, and then wash upon the shores of the U.S. That we're not going to be ground zero for the start of this. We'll be the cleanest dirty shirt until the washing machine fills up on our shores. So
what does that mean? Stronger dollar, lower yields. Everyone's buying treasuries. Everyone's buying the dollar. Wall Street probably outperforms. U.S. stocks outperform.
Can you give me a reason to be bearish a dollar, Jamie? Because technically I'm still trying to top pick it. Can you justify it in any way? What would make the dollar go lower? Because lower yields didn't help last week.
No, that's an interesting one on the yields, and as you know, we all know, but it does bear repeating. You know, foreign exchange is a relative game, so there might be several reasons to be bearish the US or bearish the dollar, and you think the yields are going down, could go down to 3.5%, as you say. Doesn't mean to say the dollar will go down because of what's happening elsewhere, and I think we're kind of maybe seeing that now. Certainly, with as we've discussed with France and Europe. And the BOJ sitting on its hands, dollar yen still near intervention territory. So, I mean, you know, the uptrend in the dollar index seems to be fairly well established.
So it's a contrarian. It's a contrarian trade then to be bearish the dollar, because most, I mean, you know, you at Reuters, I'm sure you have currency analysts, and you read most people are constructive on the dollar, aren't they?
I think so, yeah. I think for those kind of reasons, and as you said, you know, well, we've got the huge bursts on Wall Street as well. Continues money, I suppose, is still flowing in from overseas into US equities and US assets. The contrarian trade would probably be to be short the dollar. We've seen the hedge funds, as per the CFTC data, they were reducing their dollar long positions for about 6 or 7 weeks, but I think the numbers from Friday showed that that's now snapped back higher again, and so they've started to rebuild their longs again. But I mean, positions have been kind of squared a little bit, or certainly lightened. So maybe funds are going to go back long again. It's hard to say on the face of it. Or there's no obvious reason to go heavily short dollars here, other than maybe positioning or consensus view is overwhelmingly long.
All right, let me wrap it with the most important question of the whole interview, Jamie. Has NVIDIA topped? Has it topped, Jamie? Come on. What do you think?
It's topped for today.
Yeah.
It may well top again tomorrow and the next day.
Yeah, pull back.
I mean, we've seen, I think, I don't know how closely you follow these equity calls, but Goldman have raised their S&P 500 target for the year. Obviously, a lot of it's based on the AI boom.
Okay. To what?
Maybe up to, what did they say? Hold on a second.
6,000?
6,000 is possible. I think 5,600 was their target, with 6,000 possible. But Evercore, they officially raised their target to 6,000 for the end of the year, and said that by the end of next year, get this, 7,000 is possible. Wow. So when you start to get forecasts like that, do you say to yourself, hold on a second, are things maybe getting a bit out of hand, a bit too bullish? And as we all know, it's kind of the rally's been based on literally a handful of stocks. So I suppose the Fed would be more than an interested observer. I mean, because if NVIDIA and the Mag 7 take a bath, if they take 10-15% on the downside, that has a big impact on the overall market, which has a big impact on, you know, the wealth effect, consumer sentiment, etc.
So what does the Fed want? We'll wrap it with that. Does the Fed want to stop this runaway bull market in stocks? I mean, there used to be a narrative out there that the Fed, to slow down inflation, wanted a negative wealth effect to take hold. They haven't acted that way. Do you think that they want this bull market to continue, or they prefer to have some negative wealth effect to slow things down for the upper 1%, 10%?
Well, as we mentioned earlier, you know, the Fed is not in the business of, well, I don't think it is, certainly not officially, and even I think even unofficially, it's not in the business of setting market values or rates or levels, or, you know, it's not in that business. If you just take a step back, unemployment is 4%. GDP growth is still above 2%, probably on average, annual rate. So that's probably above potential slightly, perhaps. And financial conditions, and inflation is heading 2.5, 2.6, 2.7%, depending on your cut, heading back towards that 2% level, slightly above. I think if you'd asked anybody at the Fed a year ago, 18 months ago, fast forward to now, and you've got that set of macro conditions, would you take it? They'd say absolutely. And if you said, do you think the S&P would be where it is now? Do you think Wall Street would be where it is now? They would probably say no. I think most people would say no. You'd probably, with rates being on hold, you'd probably expect equity prices to be lower. So it's it is a Goldilocks or soft landing. It's a benign set of conditions overall. The difficulty for the Fed is the higher stocks go, the effect on financial conditions is that conditions are loose. They're getting looser. Yields are coming down. So that's a concern. It's just going to sort of accelerate this sort of spiral of rising asset prices, looser financial conditions that could spill through to inflation. That's a concern, certainly.
Because he said that policy is still restrictive. And you're saying financial conditions are easy. Okay, that's what I mean. Which is it? He's saying that
the two can
coexist?
They can coexist, yeah. It depends on how restrictive you think policy is, and then that's when you get into the nebulous debate about R-star, etc. There may be, in some estimates, you could say policy could be restrictive by 200, 250 basis points, 300 basis points. So if by that measure, financial conditions can loosen and continue to loosen, yet still be in kind of vague, restrictive territory. It's all a bit vague, it's a bit nebulous, and maybe people shouldn't put too much faith and store into those kind of theoretical debates about R-star. But what the Fed has done is stay on hold, and it's not cut rates, it's not cut policy rates. So you could argue that maybe policy is more restrictive than it would otherwise have been had markets had their way at the start of the year.
Will Belgium win today?
Who are they playing?
I don't know, but the guys in the room were talking about it. So I don't know. Well, anyone here?
I don't know. It's 3 minutes. Who are they playing?
I'm not sure, Jamie. Anyway, people follow Jamie at Reuters. Jamie, go check out his columns on Reuters so you can hear and read what he's thinking more than once every quarter to stay on top of things. Jamie's a great source and a great follow and a great guest to interview. Thank you so much, Jamie.
Thank you, Dale. Pleasure as always.
Enjoyed batting the ball around with you, buddy.
You too.
All right. Jamie McGeever, everybody. That's going to be a wrap for us today. You could join the team in 10 minutes on the Morning Edge. And we'll see everyone tomorrow for Turnaround Tuesday. Good hunting. And don't just count your pips, count your blessings. Thanks again, buddy.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.